Welcome back, everyone, to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co-host here alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, as usual, Texas and Florida in recent years, zoning laws, boomers, the Fed, and much more. But, Stephen, first, I just have to ask you about your life. What is going on in the large Thomas household?
Let's see. So what's going on in the Thomas household? Well, just busy season where we're all either there's soccer games going on. We got a couple in soccer. We have one in track. We have one that's training for a half marathon. That just seems to be the season that we're currently in. It's just the season taking people to their various sporting events and venues. Other than, of course, we have the 17-year-old playing soccer so she can drive herself. That's kind of fun. And so it's just like the status quo right now. We're waiting for spring breaks around the corner. So we'll have kids around for a little bit. We'll be doing some fun things then. So that's kind of what's going on. It's nothing too exciting to write home about right now within like the last couple weeks since we last had one of these podcasts. But hey, just more fun for the Thomas clan. Anyway, so that's what's going on with us. I know what you're going to talk about because I think I was there when it happened. But what is happening with your sports world, Arsenal, the soccer team? Go for it.
Yeah, I was blown away this week because we won a game in like a big tournament and went to penalties. So it was like the most suspenseful thing I have had to witness in a long time. And we won, and I can't tell you like how happy I was because it was like the first time in like a decade or something, or over a decade, and it was just a relief to see. And I am so happy. We're playing good. We're like first right now. I'm just fingers crossed we can just finish the season strong. Just a couple more months, but regardless, I just love it day in, day out. But other than my amazing team, pretty much same old for me. I'm just looking forward to spring because it's right around the corner. We're like days away now, and soon it'll be summer. And I'm excited for the extremely warm weather and the beach. So
That's always a lot of fun. Matter of fact, I was there when they were going to penalty kicks. And if I remember correctly, you didn't even want to really watch it. And then you did. It was like one of those things where, should I watch it? Should I not watch it? Should I watch it? And you decided to watch it. And it was wonderful that you were able to experience it, right?
yes, it was definitely it was just too scary, but I needed to know what was going to happen. It was just like, which one do you do? What do you choose between? Because I don't want to watch them lose. It would break my heart, but at the same time, it's my team. Like I have to watch it. I have to know what happens and see everything. And thankfully I did. So
Yeah.
I chose the right thing in the end. That's all that really matters.
Turned out
But
okay.
yeah. So Stephen, what's happening like usual with the real estate world with supply, demand, and expected market time?
Yeah, it's kind of not a lot's happening. We did see an uptick in purchase applications that had everything to do with interest rates settling down, making their way towards 7% and even below 6% recently. So with that, interest rates, so we haven't really seen that much movement. We're kind of prepping for spring. It's been demand hasn't been changing much. Inventory hasn't been changing much. So the market speed hasn't changed much. It's still really hot. This is the hottest time of the year. Typically, is the beginning of March. That's where we're at. It's typically the hottest, and it's proven to be the same thing. Where a lot of people go, "Hey, it's Super Bowl. You need to come on the market." That's typically a little bit predates when it's the best, absolute hottest point in the year, which typically happens right here at the beginning of March.
Have we seen any large economic releases recently?
Oh man, did we? So last week was Jobs Week, and the big number was Friday, and that was the what happened across the United States in terms of new employees hired, and that was a little bit higher than expectations. That was a bit of a problem, and then we went so that was kind of a negative report. It was higher than expectations, but Unemployment was lower than, I mean, went up a little bit. So that was not what people expected. Unemployment rose just a bit. That was unexpected. So it was kind of like one of those reports that was moot. There really wasn't a real positive spin on it, a negative spin. If you're looking for a positive or negative, both sides won in that one. So then it rolled to CPI this week. CPI was the big one, and unfortunately, every time we get this big increase in the number of in fuel on the fuel side of things, you start to see the headline inflation rise up. But more importantly, we look at core, and we look at core. It's not coming down as fast as people would like. It was a little bit higher than expectations, but still was lower than last month. So it's headed trending down the right direction. And one of the biggest reasons for that is because the owner equivalent rent, which is one of their big measures for the rental, for the shelter component of the consumer price index, was actually that was more in line. It was going more of in the right direction, which it should. It should. Rents, we know, are flat to down, and they're not really changing much over like the last year. And yet the owner's equivalent rent is really sky high, and it needs to come down to the levels that the actual rentals are going for across the United States. So that still has time to catch up. So core looked pretty good. So once again, if you're looking at that, it's kind of negative, kind of positive when you peel back that onion a little bit and take a look under the hood as to really what's going on in the consumer price index. So not that concerned about that. If you pave a path forward, it looks like we're going to be in the twos for core, which is where they want to be. It won't quite be at 2 by the end of this year. However, it's going to be well on its way, and the Fed will have to definitely come down in their ultra constrictive rate that they have currently. So that will change. So both of those, we kind of saw this slow uptick. And then we got to today, and that was the producer price index. And what I wasn't really expecting the market to really care that much about the producer price index, because there is a lot of volatility to that index. It goes up and down prior to COVID. And right now it's in an area where it's going up and down, almost at the pre-COVID levels. And when you look at it, it's not a significant change or anything, but the markets are making hay out of nothing. And we had a giant rise in rates today. So we saw that giant rise in rate. It wasn't humongous, but now we're back up to 7%. We were below 6. It was nice to see it below, I mean, not below 6, below 7. We were in the 6s. We were there for a week, and now we're right back up to 7%. It's stubbornly right at that 7% figure. It's kind of, this is where it's going to be until we really start to see in the works a slowdown, and most likely in jobs or in language from the Fed, which they're supposed to meet next week. And hopefully they say some great things, but I'm afraid that they're going to be kicking the can down till June, and we're going to get rates that rise above 7% until we start seeing it in the data, which, if anybody's been following me, they needed to make that rate cut back when they met at the beginning of the year, January 30th, 31st, when they had that open market committee meeting, and then they announced what's going on. And now here we are going to be in March. Know that they're not going to say yes to cutting rates now. Now it doesn't even look like it's going to happen in May. It's everybody's prognosticating that it's in June. They better do it in June, or they're going to cause some damage going forward. I'm pretty sure they know it because they've been articulating it, and that's the direction they're going to go. But you never know, because the Fed has been slow to react on things, and they're not really looking at the data lines very well. So that's what's going on with rates. A lot has gone on within the last week.
Well, fingers crossed that rates do somehow drop in the next week. But what I wanted to ask you next is, people often turn to Texas or Florida when referring to housing crashes as of recently. So if we take a look at what they've done and built over the previous decade, it is very surprising. Would you say the rest of the nation should look towards how they have handled things?
Well, they're like get that badge of honor because they have the land to do it, and that's really what it boils down to. Unfortunately, with Florida, they're in the same they're in the same spot that California is in, and they've got this big insurance problem. So probably the shining star really goes to Texas, but they have had that ability, that capacity to build, and they were already well in front of it and already had that capacity, and it only grew more over the course of the last couple years. And so that's where you saw the throttle. And what they did ultimately is created a lot more inventory. And on top of it, so right now you're getting this, since we've had the slowdown, the markets where we're actually seeing inventories rise back to where we were prior to COVID are actually in Texas and Florida, besides Boise, Idaho, and a couple other spots. They're the exception versus the rule, and they had the capacity to build. They had the land to build. So if anything, you could see what really the answer is we got to find that pathway to build for everywhere across the United States. There are some issues where there's no buildable land, like what we have here in Southern California, along the coast here in California. But there is definitely ways that you can incentivize getting things done. And we could talk more about that later.
Another question is, will rent prices continue to decrease with the oversupply we've seen in places like Texas and across the nation as well?
Yeah, well, actually, if you've been following multifamily, that's what begs the question, where they sure were able to build a lot of multifamily apartment complexes, not a multifamily where people go out there and purchase them. What most of the multifamily that's being built are for rental purposes. So plenty of that's been built, even in California where there's no room to build. They sure were able to build a lot of apartment complexes. So there's a saturation of multifamily that is continuing to this day and will continue this year, that will apply enough pressure where in some markets, if there's enough of it, will apply enough pressure for prices to come down. But you have to understand mostly of what they're building, and a lot across the United States, especially here in California, we're seeing more of luxury apartments being built. It's once again, they're catering to the higher end so that they can make more money. And, what's not really addressed in these are the bigger, the family that's looking for not the big giant stacked apartment complex, but more of like duplexes that are attached, not seeing a whole heck of a lot of that because it takes up too much land. And so you need more of that, especially for families, because families can move into that. They'll be okay with moving to that. They're not as okay moving into these giant apartment complexes. Those are for the people that are not yet married, still looking for marriage, and before they have the family and all that. So there isn't as much of the right stuff for the families that are purchasing. So that's also a segment where when you look, if you're actually looking for something that has more bedrooms, something that has a little bit of land, guess what? Those are hard to find, and there is a lot of competition within that. So that's kind of, yes, it's going to be favorable for some parts of the rental, the rental side of things, but there's a subset that has not been served.
So, in relation to sort of supply scarcity, are changing zoning laws among the few fixes for the supply side of the affordability crisis that we know of?
This is my number one fix. Seriously, it's local and state. They got to get out of their own way. There's way too much red tape. If you want to erase some red tape and supply funding to local and state to create the more entry level housing that I'm talking about, because there's really no incentive for them to build the 1,400 square foot home anymore. It just doesn't make sense for these builders. They're answering to Wall Street, and the only way to do that is to maximize the dollar potential of every lot that they sell. So the way that they do that is they put as much as possible that they can on these lots. And as a result, again, we're not addressing the entry level, housing, and the lower income or the lower middle class income that's able to get into that first house that is that jumping board to the next house down the road. So how do you do that? You erase a lot of the government red tape, and you do that through zoning changes and different things like that. You just got to get out of your own way and start looking for fixes to the supply side of the equation, because there's municipalities and areas where you don't have a lot to build, but you can still build, but it takes a lot of creative thinking, and a lot of that is around zoning, and that is someplace definitely to start. The conversation needs to grow a lot louder, and hopefully it will, now that we're starting to hear it in the United States government over at DC.
Of DC, the presidential administration stated that they can fix America's housing affordability crisis with a 10-step plan. Would you mind describing it, and if you think it'll work?
Yeah, I took a look at it. I read the whole entire thing. You know what? Bravo. My hat's off to anybody within government that's talking about and addressing the issue of the housing crisis, and the housing crisis being that there aren't people that are transacting. We don't have sellers that are selling, and we don't have buyers that are buying. So buyers aren't purchasing because of affordability. Sellers aren't selling because they don't want to sell. They have these low underlying rates, and a lot of them don't want to trade in that low rate for a higher rate. Some do, because some are growing impatient because this is taking too long. But I'll tell you, it's far less than where we would be if rates were a lot lower than where they are today. So that in looking and peeling back and looking at all the plan, they're dealing with some of the things that are the demand side of the equation. We're talking a $10,000 first-time home buyer tax credit. We're talking a $10,000 credit to sellers that are selling homes that are below the median priced home. We're talking about first generation homeowners, where if your mom and dad don't own something, that will help you with down payment assistance. A lot of that's good and fine. However, the problem is a lot of it addresses just the demand side. Now, you did hear that if you sell less than the median priced home, that you can get a tax break for that. But it's not gigantic enough to encourage enough people to say, yeah, you know what, I want that $10,000 extra dollars, when they're looking at trading in their low rate for something higher. So that's not necessary. That's kind of like a Band-Aid. And looking at all of the features of it, it's not, there is nothing that really addresses the zoning and government getting in the way of building. And that is my biggest issue that I see. My hat's off. I applaud them for starting the conversation, and hopefully it starts more conversations so that we can actually impact with some real solutions. There's a whole bunch. There's pages of their proposal, but like I said, a lot of it addresses some really lower income needs and some veteran needs and things like that. But that's just a small segment of the issue of home ownership. The biggest issue of home ownership right now is the lack of homes available, and the biggest reason for that is you can have people sell all day long and incentivize them to sell, but they become buyers typically. So how do we create more product? We actually have to build that product, and we've been underbuilding for decades now. So that's kind of an issue for over a decade. Since about 2010 on, it's been very underwhelming, the number of sticks that have gone under the ground.
So I know recently you've talked about one topic on your housing debrief episode, which will be about 2 weeks when this is released. However, you said you were talking about boomers. What would you say is key for getting boomers to downsize or moving into something different?
Yeah, there's no real answer to boomers. I heard from a boomer. A boomer says they don't have that many alternatives for them to go move to. They're not going to move to some assisted living. That's not what people want to do. So primarily what's going on is there is an industry wrapped around them aging in place, staying put where they're at, from getting up the stairs with some sort of mechanism, to elevators within the home, to tricking out the downstairs living space so that you can actually turn that into a master suite. There is a lot that's done around aging in place, because primarily most people just want to hang on to their houses and hang on to them long term until they actually have to turn in the keys to go to to go to assisted living place, or they've gone to greener pastures at this point. You know, that will create a more sellers down the road, but it's nothing that is going to be turning the needle much at all. There's a lot of speculation as to what will move this needle, but it's definitely not waiting for baby boomers to sell their homes. They just do not want to sell for the most part. Some do, and that's where there is some churn. And some people do pass on, or some people do go to assisted living. So there is churn, and that churn will get louder as this decade moves to 2030 and beyond. But it's not going to be the as big of a change as people think.
So you wouldn't call it a tsunami, but what would you consider it?
It would, you know what? It's just an increase in it's a slow, methodical increase. Every time there's a projection as to what people think is going to happen, they take out they're not quantitative economists where they're doing linear regression. Some people are doing it and they're trying to map it out, but it's very hard to map out these unknowns with the life expectancy. Life expectancy dropped, by the way, recently, and now it's on the uptick, but it's kind of plateaued right around 80 some years old. But now it's down a little bit because of COVID, but that will change over time. But there's a whole bunch of factors that go into it. And there's also mindset. And then there's also extrapolating as to what these people will do once they get the property. I mean, I hear from a whole bunch of people because we do a lot of these different kind of programs, and they slap up their comments and giggle about it and think that they've got all the answers. And some of those answers are, well, these houses are all junk, and people are just going to unload it for pennies on the dollar. And that's a bunch of baloney. That's not. Maybe there are going to be some of those cases out there, just as there are some fixer-uppers that are out there, but that's not going to be the norm or the typical. The typical is heirs are going to take over the property, and sometimes they're going to do the work, sometimes they're going to do some work, sometimes they're going to do no work. But there will be some place in the middle, and they're going to try to either live in the house and then they refurbish it like crazy, or sell the house, or rent out the house. And there's a lot of different things that they can do, and it will take time as well. So this is not going to be an instantaneous thing. We're not going to see a flood of homes come on the market. There will be more and more, but we are an industry that there are buyers that are waiting, chomping at the bit. And as soon as there's more inventory, I mean, we're starved for inventory right now across the United States. We're still not building enough houses. We're not even talking about really how do we build, because that's what was said during the State of the Union. Build. I'm all for that. I agree with that. But you got to do it by getting rid of the red tape and all the muck and the government bureaucracy. So that's not going to happen anytime soon. So actually, more and more homes coming on the market is a welcome relief. And the more we get, the better.
Well, on the topic of baby boomers, Fast Company wrote an article saying that 9 million boomers will sell their homes by 2035. Would you agree with this claim? And could it possibly help the affordability problems?
This is also another one of those projections where they're just it almost seems arbitrary when they put these things together. Because if you're an economist and you're even trying to forecast out, you're forecasting way out. The longer out you go, the more that there's the ability for errors to occur. So to say that there's exactly 9 million extra homeowners that will be selling their homes, that's not necessarily accurate, because I just told you that they're not all going to sell. Some are going to rent, some are going to move into it, some are going to do nothing with it, and they're just going to sit there. So there's going to be a lot of different answers to this. So, and like I said, we're actually starved for inventory. So more and more homes coming on the market is probably a welcome relief. And so the more the merrier. I just think that this is a bit of an exaggeration. We don't really know. 2035 is a long way off from where we're at right now. That's 11 years from now. A lot can happen. A lot can change. And even life expectancy can change from now until then. So we'll just have to wait and see. But I think that it's not going to be a saturation. It's not going to create this big, giant issue of way too much supply. It could
So
be an
we are
answer.
now
Sorry, it could be an answer to the supply problem a bit.
So what I was saying is we are now about a couple of days away from the spring market. By the time this episode is out, I think it's just like 2 or 3 days, something very minuscule. But Financial Times wrote an article explaining how the spring market will be almost frozen, like how it was for a fair share of 2023. Is this statement valid?
Yeah, it is valid because this is exactly what our forecast was. Our forecast was for more of the same until we get the drop in rates with the cooling economy. The really what happens is it will dial in very close to 2023 until we get a significant, substantial drop in rates with duration, not 1 week and then we're back to 7% again. No, and this is a lopsided year. So we're hovering at these higher rates right now. Towards the end of the year, we will be at lower rates. So when is it that the economic cool down will take place? We give it like it's almost 50-50 chance, but it's a 5% chance that it happens from the fall on, where we get this economic slowdown, we get interest rates that fall to about 6 to 6.5%, that range. Because right now we're stuck in a different range. Now down, that's 5%. Now we actually think it's like 47.5% chance it happens in either the spring or summer. Remember, we haven't started spring until next week. That's 6 more months. So there's 6 months where we'll see some sort of economic slowdown, and that is primarily what our take is, where we're going to start to see it in the numbers sometime during that 6 month span of time. Exactly when that's going to happen is anybody's guess, as you found when you listen to all the different opinions that are out there. But we feel like, looking at all of the different trend lines, that this is where it's going to fall. Where exactly does it fall? That's anybody's guess at this point.
So Jerome Powell recently came out and warned commercial real estate woes will lead to bank failures. How likely are they to happen, or is it already in the process of occurring over time right now?
Yeah, that there could be, they're warning of it so that everybody's prepared for when it does happen. It's not this giant onslaught, but there are some banks that are having some issues right now. And this just has to do with, there's been runs on the bank. They have their portfolio positions that are too heavily on the commercial sector. They're not diversified enough. So there are some issues within the commercial real estate side of things, because a lot of these regional commercial banks have loans that are due and payable. When they are due and payable and they come up, then you have to go back to the people and say, hey, you know what? You have to pay up and you have to go get a new loan. There's going to be some investors out there that are going to look at that and go, I'm not going to be able to, because they then have to go get a new loan. And when they get this new loan, it'll have too high of a rate. So then they'll be walking away from properties, and that's already began. And it's starting to spike as far as defaults are concerned, and we're seeing that in multifamily. We're seeing a spike in number of defaults, and that's where we're seeing a little bit of the angst, which could further slow things down when you have regional banking and different problems like that. That will be just more of that slowdown that we're talking about that will occur over the next 6 months. It's not going to be this pattern where it's going to be a domino effect of regional banks, but there are some that are exposed. He just wants to make sure everybody's prepared that there are some, because of these higher rates, that they're going to have an issue. And even when they cut rates, it's not going to be enough. They're all the way, remember, they were at zero for a long time. So it was easy to have these really low rates. They're right now at 5.5. So when they're talking about reducing it by 1/4 point drops this year, they're talking about getting it from 5.5 to 4.75, which is still a rate that constrains the economy and can still cause a lot of damage.
So then what can we expect from the Fed with their upcoming meeting based off of the data that we've seen recently?
Yeah, I'm actually a little bit nervous for this one. And that is because this one, they released their Fed dots. So last time in January, they said, yeah, it's wait and see. And it's definitely, he actually recently had said it's definitely not happening in March. So if your idea of a rate cut happening in March, which we still subscribe to, we think that they should, that there should be a quarter point start. It's not going to damage anything, but it's going to start to get in front of the slowdown and offer some hope for those different regional banks, as well as hope for the economy to exercise that soft landing that they're talking about. But yeah, so it's not going to happen in March. Most likely won't happen in May. It won't happen probably until June. And something I'm nervous about is they release on a quarterly basis what they call the dot plot, and that is where they project the short-term rate. That's what they're only in control of, short-term rates, which are right now it's pegged at 5.5%, which controls automobile loans, credit card debt, and it's equity line of credits, that type of thing. But they're going to put together this dot plot that's going to be a little bit higher than what they had back in December. So I'm a little bit nervous about when this thing is released and what it does to rates. So it'll be very telling come next Wednesday. It's going to be in a very important Fed statement that they make, and then afterwards Powell will do a Q&A, and then after that we'll also be able to download the dot plot and see exactly what they're talking about, and the market's going to definitely react to that next Wednesday.
So recently, Goldman Sachs Asset Management said that they will resume investing in U.S. commercial property this year because they believe the market is bottoming out. Could this be a good or bad indicator, or even not an indicator at all?
Yeah, I'm a little bit still concerned about the commercial side of things. Not industrial, but commercial retail, not a little bit of commercial retail, but more of office space. I'm still up in the air of how I feel about office space. And if they're going to dive into office space, I don't necessarily know if I agree that it's a bottom. There's still this big component of the economy where people really want the flexibility to work from home, which doesn't require as much bricks and mortar, which puts a constraint on commercial office space. So I just don't know yet. There's been enough time to really figure out what the trend lines look for commercial office space. So they might be a little bit premature in jumping back in. That's my initial thoughts when I heard this.
Awesome. Well, thank you everyone for tuning in to another episode of Let's Talk Housing. If you want to learn more about what is going on in the real estate industry across Southern California or the Bay Area, and soon Las Vegas and Phoenix, which is super exciting, please feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. And if you have any questions at all, feel free to reach us on any of our social media platforms, or you can email me personally at info@reportsonhousing.com. Thank you very much, and we will see you soon. Have a fantastic rest of your day.
Thanks.